Why does the market needs liquidity to move to the upside or to the downside? That's the topic of today's video. In the first half, I will go over some examples, and in the second half, I will explain it on a live chart example. Before we can get into this topic, we need to know where the liquidity is. As you can see right here, I have drawn here the three most important or the three most popular examples. The first one is gonna be the trend line. On the trend line, there's liquidity on the upside and on the downside. So there is liquidity sitting below the trend line and above the trend line. The next example is the support and the resistance. These are the most common one, and pretty much every trader has used it for once, I think, and that's why everybody knows it and everybody can draw it on the chart. So there is always liquidity above these resistance areas and below these support areas. Same goes to the Fibonacci. So we have the 38.2 Fibonacci, the 0.5 Fibonacci, the 0.618 and the 0.782 Fibonacci. These are the most common one. People will look for shorts from this area, and also from this area. Also from this area, and there will always be money above. So people will place their trades and their stop losses will be here. I will go in more detail with the stop losses in the live example, but for now I will just leave this right there where it was. Usually liquidity is at these points because a lot of traders use it in their trading. But how do we take advantage of this and make a profit with this knowledge? I'm going to explain it to you right now. Let's go over the live example and have a look at it. First of all, we have this example on the 15-minute time frame on Euro USD. We have created a demand area on the 1 hour chart right here. As you can see, the demand area is right there. We had a break in the structure to the upside. Now what we want to do is go to the 15-minute and we can refine our zone to this candle right there. Now what we usually do in our trading style is that we look for liquidity inducement on the higher time frames. Now what we can clearly see is this. We have kind of this support right here. A retail trader would look for buys from this area. So retail traders usually tend to buy right here if they see an engulfing. Now this is a perfect example. We have an engulfing right there, so people would place their trade right there, put their stop loss right here with 13 pips potentially, and a risk to reward ratio of, I don't know, 1 to 3. Or the next resistance area that could be here potentially. So they would look for this trade, 1.2 reward trade, and their confirmations would be the engulfing candle and the support area. You can even look to the left side, and as you can see, price has reacted at this area multiple times. So we had a reaction from above as resistance, from below as support, and people see this. They also see this as we do, but they take buys from this area. Now why do I tell you this? It's actually pretty simple. We're gonna draw the liquidity right there. So we mark that on, the liquidity is below there. People, retail traders or people all over the world have placed their stop loss right there. So what we can see right now, there is liquidity below. So many traders have placed their stop loss below and there is a lot of liquidity. Now, what the market tends to do is it wants to seek that liquidity, tap into an unmitigated order block and then continue to the upside. Now, why does price seek this liquidity? It needs to seek that liquidity so big players like institutions, hedge funds, or even Wall Street people can place their orders. You have to think like that. They can't just place millions of bucks into a buy position without other people getting taken out of the markets. If they would do that, the markets will be way too imbalanced and the markets would just go straight down or straight up, and nobody wants that. Now what they like to do is they take the liquidity from the traders, they stop them out, and there will be a small gap in the markets. So now traders got taken out, the big players can place their orders in this area, the price comes down, First of all, price goes up a bit and many other traders get in and there will be placed more stop losses. Then price comes down, takes all of these people out of the markets, and now they can place their big orders. That's also the point where we want to get involved into the markets. We know people have been stopped out right there. Liquidity has been taken from the markets. Now big players can place their buy orders inside the order blocks or demand areas, and price can continue to the upside and reach new highs, as you can see right here in this example. Now this is just one example of many, and we can take advantage from this on the lower time frames. So when price is mitigating this order block or demand area, we can drop down to the 1 minute time frame and look for entries in this area when we have mitigated and taken the liquidity. This is the reason why price takes and needs liquidity to move bullish or bearish. I hope I could help you with this and explain it to you. And if you like this explanation about liquidity, I would really appreciate a like, a subscription, and if you could ring the bell and let me know in the comments what you want to see next. And with that being said, I really thank you for watching and see you next time.